Funded in 90 Days Challenge. How can you get funded before the year ends? It sounds impossible, right? Today, I'm here to share how I went from not knowing anything to becoming profitable in futures in just 3 months, and how you can do the same. Now, here's the crazy part. I've already done this right in front of you, and most people didn't even notice. On March 2nd of 2024, I launched episode 1 of Learning and Getting Funded with Futures. On March 18th, I launched episode 2. On April 29th, I launched episode 3. And that's where I got funded in just about 60 days. And on June 17th, 2024, episode 4, I got my first payout. Now, as obvious as it sounds, I couldn't possibly show you every single thing I did behind the scenes to get funded and start getting payout in just 4 episodes. But here's some perspective. Across the 4 episodes, I spent $500 total on challenges. And how much did I make in payouts from that one funded account? Your guess? $1,000? $2,000? $5,000? $10,000? Nope. $15,118,000 is what I made from the funded account that I documented myself getting. For some perspective, that's a 30x return on the $500 that I spent on challenges. 15,118. And why am I telling you this? Because I need you to understand the power of what we are going to cover in this webinar. I'm going to break down step by step exactly what I focused on behind the scenes. The same process that not only got me funded, but also brought in over $15,000 in payouts from a single account. Now, let me ask you this. If I show you exactly what I did behind the scenes, exactly what I focused on, do you think your chances of getting funded before the year ends would increase? Do you think the probability of finally becoming profitable would increase? And even your chances of getting a payout? But here's the thing. 99% of traders fail. And it's not by accident. The odds are stacked against you. Prop firms design rules with one purpose: to keep you from ever getting paid. They put limits in place that make it nearly impossible to even get funded in the first place. And brokers, most of them don't even send your orders to the market. They're literally betting against you. When you lose money, they make money. When you win money, they lose money. Every single trading business is betting against you. And we can't be like 99% of traders if we want different results. And you've probably felt it yourself. You try different strategies, spend months testing them, and still see no progress. You invest in mentors only for them to ignore you the moment you pay. Prop firms that find any excuse in the book not to fund you. Or maybe you do get funded, only to blow the account before ever seeing a single payout. You're bombarded with information, and yet after months, maybe even years, you still don't see progress. And I know exactly where you are. I know exactly where you are because I've been there myself. I struggled for 3 years to find profitability. I jumped from mentorship to mentorship, hoping that each one would be the answer. I blew a personal account multiple times. I blew multiple salaries on prop firm challenges. And I tried everything. Trend lines, price action, smart money concepts, and I still went nowhere. These are literally screenshots from my journal. And at one point, I honestly felt like giving up. So here's my promise to you today. By the end of this session, you'll walk away with a clear step-by-step plan to get funded before the year is over. You'll understand the exact concepts that took me from an unprofitable trader to a consistently profitable one. And not just that, the same concepts that allowed me to do it in only 3 months with futures. Now you might be asking, Kimmel, what's in it for you? Here's the truth. After 5 years of YouTube, I've spoken with over 8,000 traders, and I've listened to your struggles, your setbacks, and your stories. You want to provide for your family. You don't want to look at the bills when you go shopping. You want a way out of the system that is rigged against you. And let me assure you that trading can be that way. Just like it was for Sander, who was stuck and ready to quit, and then turned it all around. And I quote, this is while he was telling his story. Telling my girlfriend I didn't know what to do. I felt so hopeless. I just didn't know how I would ever become profitable. Even if I had it in me, I just didn't believe in myself anymore. Today, he's not just funded, he's received over 50 payouts and has become a full-time trader. Or Miguel, who was able to create an extra stream of income, getting over $43,000 in payouts. Or Jeff, who went from not knowing anything about trading to getting funded and securing 7 payouts in just 3 months. And yes, at the end of this webinar, I will have an offer for you. And it comes with the most insane guarantee the trading industry has ever seen. But let's be real, that offer means nothing unless I deliver real value to you right now. So, that's what I'm going to do. But first, why does all of this work? How do I know that what I'm about to teach you today is going to actually get you funded in 90 days? Well, let me ask you this. Have you ever heard of risk management? Have you ever heard of daily bias? Trend trading? Trade management, trading psychology. My guess is that you already have heard of every single one of these things. But here's the truth, none of you have mastery in any of them. Why? Because it's too simple. It's too simple. It's too basic. And you skip over them chasing something that sounds more important. But let me ask you this. What part of building a house is the most important? The roof? The walls? The furniture? No. It's the foundation. Without the foundation, the whole house eventually is going to collapse. And this is the same everywhere, in every sport, in every building, in every skill. And in trading, risk management, daily bias, trade management, psychology are crucial for your success as a trader. You master them and everything else finally clicks. But here's the truth. 90% of traders have never mastered the foundation. And guess how many traders quit within their first year? Almost the same number. Right? 99% of traders fail. But someone asked Bobby, what was the one thing that changed his trading and got him a $4,700 payout? Bibby said, just out of curiosity, what was the missing piece in your puzzle? This was when Bobby posted his $4,700 payout. His answer? Was it small stops? Was it a secret I told him when I got coffee with him in Dubai? Or was it something simpler? Well, let me read you exactly what he said. To the question, what was the one thing? He said, thank you very much. The missing piece of the puzzle was bias. If you are bullish and price is going bearish, I was not taking trades. I was waiting for price to become again bullish so I can trade again. I hope that will help everyone in the business. It almost sounds, this was posted in August, it almost sounds like he's talking with you guys. Notice how Bobby didn't send a 50-line essay on what got him those payouts, 4.7, 4.1, and even $2,000 in one single day. It was just one thing: direction. And that's it. That's what allowed him to make consistent profits month over month. And that's precisely what we're going to dive into in this webinar, so you stop shorting when you should be longing and stop longing when you should be shorting. Sounds like something worth mastering? Bobby did it. All right, so let's get to it. In this webinar, here's exactly what we are going to cover: direction, how to master it so you're always on the right side of the market. Take profits, so how to set the right ones and consistently win. Management, how to stop getting taken out for break even. Stop losses, how to place them the way real traders do. And trading psychology, how to master the psychology that makes or breaks consistency. And on top of that, I'll be giving you 2 entry models that appear every single day, giving you multiple opportunities to execute. All of this so you can finally get funded before the year ends. And how do I know this works? Because I've documented my whole journey. Last week, you saw me getting 4 payouts. From being unprofitable, lost, but still hopeful, to hitting some of my darkest moments, to now being in the biggest trading events, networking with amazing traders around the world, getting interviewed on major trading podcasts, and becoming consistently profitable, closing in on the $1 million trading goal. But it wasn't always like this. I've been trading for 6 years, and for the first 3, I was unprofitable, searching for an edge. I tried strategy after strategy, failed over and over, and felt like giving up more times than I can count. Until I discovered the exact system that I'm about to share with you today. The same system that ultimately enabled me to travel the world, provide for my family, and achieve the time and financial freedom I had dreamed of when I was working 2 jobs and in university. The system that got Jeff funded in 20 days and getting 7 payouts in his first 139 days. Christy funded in 10 days and making over $2,900 in payouts within 2 weeks. Sander, who went from rock bottom to over 50 payouts. Tomasz funded in 30 days. Tori funded in 20 days. Mark funded in 78 days after 2 years of failing. And Fella, who got funded after 3 years of jumping from strategy to strategy. And now, how you can do it too. Are you ready to absorb all of this? Let me know. Put a 1 in the chat if you're ready. So let's get into it. To understand what it takes to become a profitable trader, we have to first understand some foundational things. Because as said, a house is just as good as its foundation. So what is a winning trade? A winning trade is when we pick the right direction and we have the right execution. And you have to keep this in mind because it will be important in this webinar. If you understand this equation, you will learn how to control each part of it. You win. If you don't, you're just gambling. You take one part of that equation out, you're going to be gambling. And in this webinar, we're going to break down each one of them clearly, starting with direction. Most important one. So first, let's tackle the big question. How do we master market direction? We do that by starting on the daily chart. That's where we use something called daily bias. So the question becomes, how do we actually find the daily bias? Daily bias means finding the market direction for that trading day, for today. Today on the Telegram, every single day on the Telegram, I sent you my daily bias for the day, not for what's going to happen next week, today. And we do that by analyzing the daily chart. And here's how we do it. The first step is to identify the key levels the market is reacting to. Now, what do I mean by key levels? These are places on the chart where the market consistently shows respect. They include daily order blocks, daily fair value gaps, external liquidity, internal liquidity. When you identify these levels, something very powerful happens. You begin to see what the market is choosing to respect. Not what you want it to respect, what the market is choosing to respect. And if it's holding at bullish levels, or is it rejecting from bearish ones? Let me give you some examples. This is on NASDAQ. I marked out all of the bearish order blocks. They are in red, and all of the bullish order blocks, they're in blue. Sorry, in green. Blue if you are colorblind, which is fine. So in red, you can see the market is going down. What is it respecting? It's respecting the bearish order blocks. Am I correct? While the market structure is bearish. And when it becomes bullish finally, it's just respecting bullish order blocks. All the bearish ones are being disrespected. Also with daily fair value gaps, we have fair value gap on the daily, 3 bearish ones and 4, 5 bullish ones. External liquidity. Notice where the huge shift in the market happened at external liquidity. In internal liquidity, you can see they're a little bit smaller. You might have some trouble seeing it, but there's tiny sweeps that you can see on the daily chart of the market, not only sweeping, but then having a strong reaction off of it. Internal range liquidity is very, very important. Now I want to go back to this because what I said is very important. When you identify these levels, something powerful happens. You begin to see what the market is choosing to respect. Is it holding at bullish levels or is it rejecting from bearish ones? Because now, let's put all of these together. Can you see that when the market was bearish fair value gaps, bearish order blocks, not only were being respected, they were being overlapped, which shows you how bearish the market really is. So that's why all the way on the way down, we were bearish. I was only shorting on the way down. And then, once we finally had the bullish sweep, and we had a very strong reversal, this was a 15% reversal in one day, we just became bullish. I have here an example. You can't hear it, but this is me explaining inside of the community that everyone is trying to find the short. Everyone is trying to find the short in the market when the market was already bullish. So that simple distinctions helps us with our bias. Asking ourselves, what levels is the market respecting? What is the market respecting? Stop thinking what you think. What is the market doing? What is the market telling you? If the market is respecting bearish levels, our outlook for the day is going to be bearish. If the market is respecting bullish levels, then we lean bullish for the day. And just by doing this, you'll notice how much more clarity you're going to have because you're going to stop guessing. You ask the market, listen, what are you respecting? Let me see what you are respecting. Because if it's bullish levels, you're bullish. If it's bearish, you're bearish. Because you're no longer guessing, you're simply following what the market itself is showing you. You saw this exact thing happening during the week ahead of the webinar. I was doing this live in front of you. On Monday, this starts on that bullish candle. Monday, I was bullish and we took one win. On Tuesday, I would have leaned bullish, by the way, but I wouldn't have traded, but I did have an accident, so I couldn't even do the breakdown. I'm sorry. But then on Wednesday, I was bearish. I took one win. On Thursday, I was bearish and I took no trade because the market just went, which is fine. And then on Friday, I was neutral or bullish. Why? Because the market is respecting out of the bullish order block. So if we go back to the previous slides where I was saying, what is the market choosing to respect? It was respecting the bullish order block. So of course we were going to be either neutral or bullish. And I took just a small loss on Friday and it was a long. I wasn't shorting it, I was long. What was my forecast for the week? On GU, bearish for the week. And I took one trade and I took one win. And when did I trade? When the market told me, listen, I am reacting from the bearish PD race. One trade, one win. So overall, the week before, I took 4 trades, 3 wins, and 1 small loss. The loss was minus 0.5. The result for the week, Kopros max allocation, Muhannad got 150k funded, Frankie got funded, Christian got funded, Cam got funded. Now some of you are probably thinking, Kimmel, I've done this before. I've marked the levels, but the market just reverses on me. And in just a moment, I will show you how to put an end to those constant break-evens. Because maybe this is what your week looked like. Market goes, and then it reverses on you, take a break-even, or worse, a loss. Once we know the direction of the market, once we know the direction that the market is heading, the next step is just as important, where it's likely to stop. So if we recap quickly daily bias, it's all about seeing what the market is doing. What levels are you respecting on the daily? Nasdaq, what levels are you respecting? Hey, I'm respecting the bullish order blocks. Okay, I'm bullish then. If you're bullish, I'm bullish. I'm trading you, so if you're bullish, I'm bullish. If you're respecting bullish order blocks, I expect you to keep respecting bullish order blocks. But once we know that, the next thing that is important is where it's likely to stop. And how do we figure that out? By understanding one very important concept. The market moves in waves. Just like at the beach, the water crashes in when there's a wave comes, crashes in, pushes forward, and then retreat for another wave to come. Price does the exact same thing. I want you to think about an uptrend. Okay? I want you to think about an uptrend. If you have a notebook, I want you to draw an uptrend on that notebook. I want you to draw that uptrend on the notebook. And if you don't have a notebook, you should, because we're going over a lot of stuff today. I want you to think about an uptrend. If you don't have the notebook, just think about it. Okay, imagine you drawing an uptrend. Was it this that you drew on your notebook? Was it this that you imagined? A straight line up? Or was it this? Right? Can you see what you just pictured? The market is reacting from bullish PD arrays. The market pulling back towards the previous down move, which becomes an order block. You have the impulse and you have the retracement. The retracement creates the bullish PD arrays, the bullish key levels. And then we have the next impulse. When the market finds the key level it's reacting off of. The market moves from key level to key level. Bullish to bearish, bearish to bullish. It's a cycle. Just like at the beach, when the wave crashes in, eventually it retreats. And then it goes, and then it retreats, and then it goes, and then it retreats. Same thing with the market. It moves from bullish to bearish to bearish, bearish to bullish, so on. It's a cycle. And you can see it here. The only thing that I added of the previous drawing was now I drew a downtrend. Right? So you can see the market reverses, goes to a bearish key level, comes back down. Then impulses up when the market is bullish, goes to that next key level, the bearish key level, reacts, finds a bullish level, and then it starts respecting those bullish levels. There's nothing random about the market. Every move has a reason, and that's something you really need to understand. And how do we do this? The way we do this is by finding the closest opposite key level on the daily chart when we're looking for bias. For example, if price is reacting out of a bullish order block, the next target is usually internal range liquidity. When we just reacted off of a big low, the next target is going to be a bearish order block. If we just swept all-time high and we start retracing, then our next target becomes a bullish order block. Don't worry, let's look at some examples. Notice, let's do a daily bias exercise together. What are we reacting of? We are reacting out of a daily fair value gap. We swept internal lows. So let me even mark it out here. So we have fair value gap. We swept internal lows and we reacted bullish. And now we have an order block right here. And that's where the market is at now. Look, our next target is going to be the internal range liquidity. And then we reach the high. Then we sweep the high. And what happens after? We just swept the high. we just swept a key level that is bearish. What level are we going next? A bullish level. So that's where the market goes into next. And now we're at the bullish level on a bullish market structure. So what do we expect? We expect the market to reject. And once it rejects, what is it telling us? Listen, I'm reacting from key levels, bullish key levels. So if we had to bet where the market is going next, what is the bias for this specific day? It's bullish. What about the next day? We already reacted. Look, we created a new order block. We're inside of the order block. What is our bias? It's bullish. Now on the next day, what is now our bias going to be again? We've already reacted from the key level. We already went bullish. So where are we going next? We've just gone bullish. Where are we going next? Bearish, which is the high. And we reached the high. This is why understanding the flow of the market is so important. If you don't, your trades will keep pulling back to break even, or worse, into a loss. Because the way you avoid the market always coming back to break even comes to one simple step. Stop targeting in external range liquidity. I want to come back to this, where you see that the market doesn't reach external range liquidity. And if you would have held, let me quickly go back here. Look, it took the market 1, 2, 3 days to get to that high. In those 3 days, the pullback could have been that huge that you would have been tagged out for break even. While if you would have taken the trade and taken the win on the day, you would have profited. So, bullish to bearish, bearish to bullish. We can see it over and over again. This is so important. Notice how we sweep the high, we go bearish. If you would have held the trade from the first day that we said that we were bullish, the market would have tagged you out for a break even. Because think about it. How many orders do you think are needed to keep this retracement going? Not that many. This is tiny retracements. This is 5 minutes. The market doesn't care. It's gonna sweep it. But what about this reversal? How many orders do you think it takes to turn the entire market around? Way more, a lot more. To the point that even the next move, bearish, couldn't do it. So if anyone took this specific trade, which would have been a bearish trade, and you would have been right for some time, you took a break even. Or worse, you took a loss. But you were right. The target simply was wrong. Because you are targeting external range liquidity. This is going to be your demise. Big swing sweeps don't just happen out of nowhere. And when you aim for those big moves, it usually ends the same way. A pile of break-evens and a lot of losses. That's why we target internal range liquidity instead. You always target internal range liquidity. It's what has allowed Sander, Bobby, and even myself to catch these trades. Each of these are trades from them. Trades that most others would have been stopped out. I know you might not be able to read this, but I wanted this here because on the 11th of September, I sent this message to the Discord saying, over the last few weeks, what's been making money is taking profits. Letting traders run has been tricky as the moves happen after further manipulation. This is why you've seen me taking stops, taking profits, and moving my stops. Right? Now, let's talk about the perfect entry. So that's in terms of targets for your daily bias and for your trades. It's always going to be internal range liquidity. And by the way, we're going to talk about the perfect entry. And just like at the start, we need to start answering, what is an entry? An entry is just a thesis. The market is more likely to move towards this specific area than it is to move to this one. Right? We see this screenshot. It's less likely that the market is going to go towards the high than it is. It's less likely that the market goes towards the high and more likely that it goes towards the low. And when you have that thesis, you literally get your stop loss and you take profit, depending on where price is at right now. And notice how I already have internal range liquidity marked out. So the next step is this. How do we actually determine the entry, the stop loss, and the take profit? That's what we're going to cover right now. How to choose the right entry, the right stop loss, and the right take profit so that you can trade with confidence. Because when it comes to entries, I'm going to give you an exact checklist that you can follow. But before that, I want you to understand why you're taking these trades. Because the checklist only works if you truly understand the framework. That's something that I live by. Know the why and then the how. That's when I became profitable. When I understood why I was doing these things. A checklist doesn't work. The framework I use is something called the market maker model. Now, do you recognize this screenshot? I used this screenshot from before. Right? This is the screenshot that we had before when we were talking about the uptrend. So, now this is an embellished one. This is a market maker model. In this case, this is a market maker buy model. The market maker model has two sides of the curve, the buy side and the sell side. You have the buy side of the curve, you have the higher time frame PDRA, and you have the sell side of the curve. This is the market maker buy model. So basically, these are the same, simply inverted. What does it actually mean? It means that no matter how bullish the market is, there will always be some bearish price delivery along the way. And even in a bearish market, there will still be bullish price delivery. When we forecast bullish price delivery, that's called a market maker buy model. And when we forecast bearish price delivery, that's called a market maker sell model. Now, I know what you're probably thinking. Okay, but how do we actually know which type of price delivery to expect? Remember what I said a profitable trade is? It's just two things: the right direction and the right execution. Now, I've already shown you how to build your daily bias, right? A market maker buy model happens when we have a bullish daily bias. A market maker sell model happens when we have a bearish daily bias. See how everything is piecing together? Now, wait until we get to entries. Now, let's take a closer look at market maker models. We'll start with the market maker buy model. Here's how it works. First, the model begins with the sell side of the curve. This is where traders are tricked into thinking the market is going down. How many times has this happened to you where the market is going down and you're like, oh, I guess it's going down, let me short. That's exactly what they want you to do. Then prices reaches a higher time frame key level. We've talked about that. And this part is important, so keep it in mind. Price reaches a higher time frame key level. Because that's where we expect the buy side of the curve to begin. It's at that high time frame key level. So are we longing now? Now, go. Yeah. No. From there, the market will give us multiple chances to long through multiple market shifts. But let's not get ahead of ourselves. So what about the market maker sell model? It starts the opposite way. We have the buy side of the curve where traders are being led to believe that the market is moving bullish. And then our expected delivery plays out. We start moving bearish and market shift and you can execute. And just like in the buy model, during the sell side of the curve, we will have multiple opportunities to short. Now, let me see if you guys are paying attention. What was the one thing that I told you to remember? The higher time frame key level. This is absolutely crucial when it comes to predicting the market. But how can we define the right higher time frame key level? First, what do we mean by higher time frame? Well, on NASDAQ, for example, we build our daily bias on the daily chart. But when it comes to finding the higher time frame key level, we drop down to the 1 hour and the 15-minute chart. This level is the closest bullish order block or closest fair value gap in line with the daily bias. So in this case, we have before the market opened. This is what the market looked like before the market opened. This is the 1 hour chart. We have market moving bullish, obviously, bullish market structure. But this is before the market opened. So our job now is identify the key level. Look, bullish order block, it's the closest one. And we have internal range liquidity. Notice how I'm already showing you that I always look for internal range liquidity. And the delivery, after we already went to the order block, is bullish. Now, next day, let's think about this. Order blocks, what order blocks do we have? Fair value gaps. There you go. Multiple order blocks, bullish order blocks that the market is respecting. The market is telling you, listen, I'm bullish. So what is your one job? The delivery is bullish. Before the market open, let's think about this. Let's look at this chart, identify some fair value gaps. Look, we have a fair value gap, and just recently we had formed a new order block. And we have internal range liquidity. And the market delivers to the downside. So what's the most important part of the market maker models? Two things. One, defining the direction. And two, defining the higher time frame key level we want to see the reaction from. Direction, we've already talked about. And higher time frame key level, which we've just talked about. It's the closest order block or fair value gap to price on the 15-minute or 1 hour chart. And here's how we are going to use it. Once we identify that key level, we're going to wait for 9:30 a.m. New York time, which is the market open. This applies on NASDAQ. That's when we look for the manipulation into the key level. And that's when we look for the reversal. So you don't execute on the higher time frame PD array. Why? Because there's going to be multiple ones. So you don't want to force the PD array. What do you want to do? You want the market to show you once again, hey, I'm reacting from here. Just like we did on daily bias, we want the same thing happening at 9:30 a.m. I am reacting from here. Now you can execute. Remember that this manipulation will be the first curve of the market maker model. Exactly what we want to see. This is tricking people into thinking that the market is moving lower in this case. That manipulation phase becomes the sell side of the curve, and the higher time frame key level being tapped becomes the reversal point. And the delivery that follows is the buy side of the curve. Because once you have those, you have the bias, you have the higher time frame key level, and you have the market shift, the entry becomes the easy part. Especially when I share the entry models with you. Like I'm telling you right now, I don't know how many of you have finished the puzzle. You know those final three pieces. Those final three pieces are like the most pleasurable ones to put on the puzzle. Because you've been doing this for so long, and you finally have those final three pieces that make everything perfect. Those will be the entry models. But first you need to build a puzzle. Keep in mind that when shorting, everything remains the same. Once we identify the key level, we wait for the 9:30 a.m. New York time, which is going to be the market open. That's when we look for manipulation into the key level. And that's when we look for the reversal. You don't execute at the higher time frame PD array. You wait for the reversal from that higher time frame PD array, from that key level. By the way, PD array and key level, they're the same thing. So from there, you don't execute on the higher time frame PD array. You don't execute on the key level. You wait for the market to show you, yes, I am reacting from this key level. This manipulation will be the first part of the market maker model, exactly what we want to see. But while we're talking about key levels, let's first tackle stop losses and take profits. Because keep this in mind, the entry will become the easy part once you know all of the pieces of the puzzle. Stop losses. The so feared stop losses. Come on. I thought we didn't go. I thought we didn't have a stop. No, you only took one. I only want to take one. Does anyone here like getting their stop losses hit? Does anyone here like their stop losses getting hit? Personally, I don't like it. I'm gonna be honest. I don't like it. But hey, it's part of the game. Sometimes our bias, no matter how clear it is, can be wrong, or we can be a little bit early, right? The market can go to the next PD array and then do the shift, right? It can happen. And that's fine. Because here's an example. 50% win rate, 1 to 2 risk to reward, over 1,000 trades. 1,000 trades and 10 different possibilities, 10 different calculations. The max drawdown was 11%. So you still took losses, but in every single one of these situations, you profited in every single one of them. No matter how good our strategy is, we still have losses. Our job is to minimize them. And that's what I'm going to show you now. Notice, remember, this week, ahead of the webinar, from trades that I called live, I took 3 winners, 1 loss. It's still fine. The loss was minus 0.5. How beautiful is that? That's what we want. Losses are fine. Real traders don't set their stop losses by thinking in terms of money. They set them based on price action. That's exactly what Kvaz did, one of our students that joined, and he began managing his stops this way. And today he's a funded trader with multiple payouts while being a trucker. Kvaz is a trucker and has multiple payouts. So, what do we actually use to define our stops? We use something called the 3 PD array rule or 4 PD array rule. Now, PD array simply means key levels. These can be order blocks, fair value gaps, swing highs, and swing lows. And here's how it works. Let's say you're entering on the 1-minute chart. You'll count 3 key levels on that same chart, and that's where you place your stop. Let me give you some examples, okay? I'm always going to give you examples. This is a trade that I took in front of you. Entered, fair value gap, fair value gap. Let me even go here. So we have fair value gap, order block, and those are my 3 PD arrays, and my stop went above. Another trade, market reverses, fair value gap, order block. That's my 3. I will show you that these were even 4. Next one, market entry, a little bit later into the move. But notice how my stop loss protected me. Why? 1, 2, 3 protections. 3 PD arrays protecting my stop. Or another one, market shift. I enter 1, 2, 3 protections. But maybe you want to increase your strike rate. Right? Maybe you guys want to increase your strike rate even more. 75% is not good. Just kidding. To do that, you will have to lower your risk to reward ratio a little bit. It's normal. If you want a higher strike rate, you're going to have a lower risk to reward. It doesn't have to be an extreme difference, by the way. And that's when we use the 4 PD array rule. So let's look at the same examples, but this time apply the 4 PD array rule. So we have fair value gap, order block, and the swing high. Notice how this is not a bad risk to reward. It's not the best one. It's not my best trade in the world, but it's not a bad risk to reward. Here, once again, I forgot to put the swing low, by the way, on this one. So we have 1, fair value gap, order block, and next order block. So here it was even 5 PD arrays protection. Next one, fair value gap, order block, low, and bigger low. And stop doesn't go at it. It goes a couple of pips or handles below it. Okay? Again, fair value gap, order block, and swing low. Your stop loss goes below the swing low, 2 handles below the swing low. So can we see how the way that we put our stop losses are based on key levels? Because we know that is how the market talks to us. The market shows the levels it's reacting off of. It shows the levels that it's creating, and we're just adapting to them. So I don't put my stop loss based on, where would I lose $2,000 here? Where can I not lose any money? No, it's always 3 or 4 PD array protection. Now you might be asking, okay, Kemal, if it's one or the other, when do we use the 4 PD array rule? If you think that the market is in a lower probability condition, I recommend you using the 4 PD array rule. If you're confident with the direction, if you're confident with the levels, just like I was last week, you use the 3, right? Let's talk about take profits. So we've talked about direction, market maker models, take profits, internal range liquidity. Let's talk about take profits. When it comes to take profits, it's important to think about the way profitable traders think. And to do that, we first need to understand why risk to reward even matters. Because trading profitably is always a balance between 2 things: risk to reward and strike rate. It's literally math, okay? And here's what it means. If your strike rate is high, so if you're almost always right, you don't need as big of a risk to reward. If your strike rate is low, then you need a much higher risk to reward to make up for it. And the reverse is also true. The higher your risk to reward depends on what you're focusing on. If you're focusing on strike rate, focus on the part above. If you are just thinking, how can I optimize my risk to reward? You think about the bottom one. The higher your risk to reward, the lower your strike rate can be. But if you aim for a very low risk to reward, your strike rate has to be high. And after 6 years of trading, and speaking with thousands of traders, I've seen a clear pattern. Traders who only chase huge risk to reward setups almost never become profitable because their strike rate is so low. I'm not kidding you. One of the first questions I ask to people is, what is your average risk to reward? Because that usually tells me what people's strike rate is. And they tell me 1 to 5, 1 to 6, 1 to 10. Even 1 to 3. Nah, I love 1 to 3. I know what people's strike rate is when they tell me something like that, because I know it's a balance. The best traders find a balance, a medium risk to reward paired with a great strike rate. And that's exactly how we are going to approach take profits. Anything below a 1R isn't reliable over the long run. So we don't even consider it a solid trade. The reason why is because in order for you to just break even with 1R, you need to make like 51% to account for commissions and etc. 51% strike rate. And I want you to be very profitable. I don't want you to be on the edge of profit. I want you to be profitable. So our goal is to line up a 2R with a key level on the left. And how do we pick those levels? Simple. We move up 1 time frame and look for internal range liquidity. Then you mark out your 2R target and you see what level it matches with. If your entry is on the 1 minute, you look for 5-minute internal range liquidity. If your entry is on the 5 minute, you look for 15-minute internal range liquidity. Here's an example of a trade I already showed you, and I already showed you the target being internal range liquidity. This is a 1-minute trade, and it's the 5-minute target. Notice how we have a 1 to 2, and this was actually a 1 to 2.25. I will explain. A 5-minute trade with a 15-minute target. Notice how here my risk to reward is actually 1 to 1.4 because I'm targeting internal range liquidity. And I'll explain to you why. If the level is too far away, you tighten your take profit to 1.5 to make it more realistic. On the other hand, if your take profit looks too small, you can expand it to 3R. You can expand it to 3R to match a stronger level on the left. So once again, here you could see this was the trade that I took on the 5-minute, and the 1 to 2 was very far away, right? This was a 100 and something handle stop. So I didn't want to hold it for so long. The market eventually reached it, but I didn't want to hold for that long. And then this 1-minute trade, it was above the 1 to 2 because I was like, listen guys, if this goes, this is just going to tank. So I wanted to make sure that I allow me to maximize the risk reward. That's why I say that if the level is too far away, you can tighten your take profit to make it more realistic. Because let's say your 2R is at is that external range liquidity, then you're already not doing what I'm telling you to do, because we're targeting internal range liquidity. I want you to be profitable. I want you to make money. I want you to be consistent, and this is the way. And if it's too far and if it's too small, you expand it to 3R. So we have both balances. This way, you're aligning risk to reward with the actual market structure. And here's the beauty of it. By trading this way, you only need to be right about 35% of the times to be profitable. And trust me, when you combine this with direction, market maker models, high time frame key levels, you'll be right way more than just 35% of the time. So where do most traders fail? Right? Seems simple. Higher time frame key level, daily bias, 1 to 2, 3 PD raise. Their downfall is in trying to be too precise. They think they have to nail the perfect entry, the perfect stop loss, the perfect take profit to be profitable. And what happens? They get tagged out. Only for the market to move the exact direction they wanted. How many times has that happened to you? You take a trade, you have your direction, the market tags you out, and then it goes. It goes in your direction, the direction you forecasted. How many times has that happened to you? Once? Twice? 3 times? Too many to count? I can tell you that with me, it was too many to count when I was trading these other strategies. It's too many to count. The truth is, a lot of you could already be profitable by just focusing on what we've covered so far. Giving your trades more room with better stops based on price action. Not chasing precision for the sake of it. And aiming for the right take profits. Notice, my trades were not precise. Out of all of those trades, I had one trade precise that didn't have any drawdown. All the rest they had drawdown, it's fine. If you've got the direction right, the right stop loss, and the right take profit, it's only a matter of time before you profit. If you have the direction right, the right stop loss, and the right take profit, everything we've talked about right now. But here's another problem. A lot can happen in that time. And there's one deciding factor that will determine whether you actually become profitable or not. And that factor is you. And this is where trading psychology becomes incredibly important. So let's dive into trading psychology now. Once again, I know that we've covered a lot already, but we can agree that there's been a lot of value so far. Can we agree that? Let me know in the chat. Hell yeah. Now, don't worry, we're still going to talk about entries. But before that, we need to cover something just as important, which is going to be trading psychology. Now, again, all of this is going to build on what we are going to talk about entries, because when it comes to entries, I'm showing you everything and I'm bombarding you with, hey, and then this, and then this, and then this, okay? So, the truth is, it can actually be simplified. Here's a simple formula for psychology. Emotion equals reality minus expectation. Let me give you an example. Emotion equals reality minus expectation. If you enter in a trade and you expect it to win and it's a loss, emotion equals minus 1R, which is the reality. You took a minus 1. And expectation is that you are going to get a 3R. So in reality, emotion equals minus 4R. So not only did you get stopped out, but you were also taken away from the profit that was yours. This is the exact problem that traders run into. Their expectations don't match reality, and that's where emotion comes in. And when that happens, it creates all kinds of issues. Overtrading, over-risking, big drawdowns, and even blown accounts. I know most of you that are watching and you've blown an account, it's been because of emotion. So what do we do about it? Let's go back to the equation. Emotion equals reality minus expectation. If you enter in a trade and expect it to win and it's a loss, emotion equals minus 1, minus plus 3, that's minus 4. So, can we change reality? No. The only thing that we can control is our expectation. So our goal as traders is to reduce expectations that we place on every single trade that we take. And what does that mean? It means that when you enter a trade, it should already be prepared for the worst case scenario, that this trade could be a loss. Why? But why are your expectations always high? Why is it? They're high because you're entering in a trade, and when you do, you're following a checklist, and you execute if everything checks off. Let me explain. Which means you're only looking for reasons why the trade is going to win. That's why you entered. Every time we plan a trade, we go through the checklist. Yep, I have this, I have this, I have this, I have this, I have this. Perfect, I'm executing. That's what you do. You have to do that. You have to do that when you enter in a trade. I'm going to give you a checklist. When you enter, I want you to be like, yep, this. Okay, perfect. We have it. I'm going to enter. That's amazing. And that's what we have to do. But we also need to do the opposite. The opposite? Fuck do you mean the opposite? Before you take a trade, or after you take a trade, I want you to stop and ask yourself, why could this trade be a loss? Why could this trade lose? Let's look at an example. This trade, I took it live. It was funny because I had a mistake with the recording, and eventually I recorded after I executed on this trade. The daily bias was bearish. The 4-hour and 1-hour were reacting from a bearish fair value gap. We had the market open. We had the 1-minute sweep of the highs. We have a 1-minute market structure shift, 5-minute market structure shift. But what were the cons? Look at the daily. The daily is incredibly bullish. At any point, this is a ticking time bomb. It's just going to move higher. Little market open manipulation. It was the first 5 minutes of the market, which are very erratic. And we already swept internal range liquidity when I entered. So the target could have been gone. So notice how the pros outweigh the cons. We have way more reasons to enter in a trade than to not enter in this trade. But the cons still exist. And that makes a loss, in my mind, a possibility. And this isn't just something we do before entering a trade. We also do that while we're already in a trade. If you're in profit, you ask yourself, what's the worst case scenario? You're running 2R, but you've managed your stop to break even. The worst case scenario, there's still reasons why the trade is going to move to break even. And I want you to look for those reasons. Even when a trade is winning, you should still look for reasons why it could turn into a loss or a break even or the amount that you've managed to trade to. That's how you stay prepared. And that's how you reduce emotion. If you're in drawdown, it's the same thing. The worst case scenario is simple. The trade becomes a full loss. So when you're in drawdown, you look for reasons why that will happen. And just so you know, this isn't theory. Well, it is theory, but I do this every single time. Now, you maybe can't read the screenshots, but I want to show you that these are multiple screenshots of me talking against my trade. I'm in a 50 handle stop. We swept the highs, which means that we might manipulate. I have a 1 hour screenshot, and I say it could have a 1 hour power of 3 here, which means could take a loss. Or another one, the 15 minute is meh, but I don't dislike the trade. I'm already saying the 15 minute doesn't look good. Another one, 5th of September, new 1 hour open, trade very likely turning into a loss. And I said, out for minus 1 hour, bias remains the same. Right? So everything, what are we really doing here? We're changing the expectations of the trade. We are removing the power that the trade has from saying, no, this is a win, this is a win, this is a win, this is a win, into, no, there's the likelihood this is a loss. And I want you to think that way. Just to be clear, no, this has nothing to do with the law of attraction. I love the law of attraction, but this has nothing to do with it. Looking for reasons why a trade might lose does not make it more likely to lose, okay? Think about it. Up until now, you've been doing the opposite. Just reasons why the trade is going to win. You've been looking for only reasons why the trade should win. But your results haven't matched that, have they? Right? The reason I'm saying this is because I want you to notice that the law of attraction won't make a role here, right? And believe me, I always talk highly of myself. I believe highly of myself because of this that people call law of attraction. But the market does not care about your feelings or expectations. Okay? That's why we have to stay as rational as possible. So, that's how you treat trading psychology, by the way. Reduce your expectations. Look for reasons why the trade is going to be a loss. There's going to be an order block. There's going to be some conflict with the daily bias, the 4 hour, the 1 hour. There's going to be levels the market is reacting off of. There's going to be a level the market has swept. I want you to imagine those creating your loss. Because like that, if it does indeed happen, your expectation is already at the worst case scenario. So therefore, it's fine. You don't feel as much emotion. We've talked about how to find the direction. We've broken down the market maker model framework. We've covered stops, take profits, and even the psychology behind this all. And now it's time to finally reveal the entry models. Now, the framework we've built so far is incredibly important to understanding the entry models because now we're going to put everything together. It's the last 3 pieces of the puzzle. And yes, putting all of this together will allow you to become funded in the next 90 days. There's 2 types of entry models that we'll be using. It's the reversal entry model and the continuation entry model. Let's start with the reversal entry model. Here's the exact criteria. I'm going to stay here for just a little bit. If you want to screenshot, if you want to write it, I would rather you take a screenshot because I'm going to show examples. So the exact entry criteria for the reversal entry model. Trade in line with the daily bias. Wait for 9:30 a.m. manipulation. This is for NQ. Tap of a 15-minute key level, and you wait for a 1-minute or 5-minute market structure shift. This depends on the trader. Why do I say that this depends on the trader? It's because not everyone can be trading the 1-minute. This applies on the 5-minute. This applies on the 15-minute. But I'm using this as example because it's what I use, okay? So you enter on the closest 1-minute or 5-minute order block once we have the 1-minute or 5-minute market structure shift. So if you have a 1-minute market structure shift, you enter on the closest 1-minute order block. The stop loss is going to be with a 3 PDRA's protection, and the take profit is going to be at 1 to 2R, adapt to 1.5 or 3R depending on liquidity targets. Notice how everything we've talked about so far is here. Trade in line with the daily bias. We've talked about daily bias. Wait for 9:30 a.m. manipulation. What is this? This is the sell side of the curve, the manipulation side of the curve. Tap of the 15-minute key level. Tap of the higher time frame PDRA. Wait for the 1-minute market structure shift. Wait for the key level to show you that it's a key level. Enter on the closest order block. Stop loss 3 PDRA protection. Take profit 1 to 2 and adapt it. Imagine I started with entry criteria. You guys would have been like, what do you mean? I would have been like that. So here are a couple of examples. We have a bullish daily bias, market swept the big low, already reacting. It's showing you I'm reacting from bullish. So therefore, our target is going to be a bearish PDRA. We wait for 9:30 a.m. to a key level. Notice 15-minute order block right there. It was tapped into. We have a 1-minute market structure shift. And we have a 3 PDRA protection. If you wanted 4, the stop would have gone below. And we have a beautiful 1 to 2R. I think this is a 1 to 1.5, by the way, which is 5-minute internal range liquidity. Here's an example on the 5-minute, bearish daily bias. We target the extreme on the daily. The market, by the way, is obviously reacting from bearish PDRAs. We've seen that before. Bearish fair value gaps, bearish order blocks. We wait for the 9:30 a.m. manipulation to a 15-minute key level. We have a beautiful fair value gap, 2 fair value gaps that were respected, and a huge order block. Let me quickly show you. Fair value gap, order block, everything. Wait for a 5-minute market structure shift. This is for the people that want to execute on the 5-minute. And boom, we have a beautiful 1 to 2R targeting internal range liquidity. Now, the reversal entry model on its own is not enough because sometimes life gets in the way and we miss the reversal. That's why we need a way to execute while the market is already moving. Keep in mind, this applies like Kvaz is a trucker. I was working 2 jobs. We have so many traders that are actually working full time and doing this consistently. I'm going to show you so many of them. And here's the best part. The continuation is even higher probability because the market has already laid out its plan. Not only has it reacted from the key level, but it's already said, hey, not only have I reacted once, I've reacted twice. So this is even higher probability. I love the continuation entry model, by the way. So let's go through it. Here's the exact entry criteria for the continuation entry model. Take a screenshot if you want. In line with the daily bias, wait for the 9:30 a.m. manipulation, tap of the 15-minute key level, wait for a 1-minute or 5-minute market structure shift depending on the trader. Guess what? This is the exact same as a reversal model, right? But now you wait for the second market structure shift on the 1-minute or 5-minute, and you enter on the closest 1-minute or 5-minute order block. The stop loss will be with the 3 PDRA protection and the take profit at 1 to 2R adapted to 1.5 or 3R depending on liquidity targets. Can you see? It's the exact same thing, but we wait for one more market shift. One more time that the market tells you, no, I'm actually reacting out of here for sure. So this is an example. We have a bullish daily bias. We're so close to the high, so we target all-time high. We have 9:30 a.m. manipulation towards the key level. We have 1-minute market structure shift. We have a second 1-minute market structure shift. So we have the pullback and then the market shifts again. We enter and we target the 1 to 2. In this case, trade that we took together, bearish daily bias, 9:30 a.m. manipulation to the 15-minute key level. We have a 5-minute market structure shift, which is what you see on screen right now. And we have the second, at this point, I was already out of this trade. At this point, we have the second 5-minute market structure shift, and we target internal range liquidity for a 1 to 2. So now we have everything. Did this help so far? Let me know how you guys are feeling. Have you gotten value so far? Did this clear doubts? Do you see a path more clearly now of what you have to do tomorrow? Let me know in the chat. Or better, I want you to describe in one word how you're feeling. Clarity, confidence, maybe a little bit overwhelming. Let me know, because this is the thing. We've talked about a lot of things. I've been doing this for 1 hour and 5 minutes now, a little bit more. Some people are going to feel overwhelmed. That's fine, right? This is going to be available for you to watch for about a week. So you will be able to come back to this, okay? But let me know how you're feeling in the chat. Motivated, confident. Nice, yes. Confused, goddamn. Again, it's fine. It's fine. Again, it's very important to understand that if you're confused now, it takes time. You just got a lot of information, okay? So, what did we learn today? Let's sum it up. This is everything we went over today. What is a winning trade? How to find the bias for the day. How to use the right framework to look for trades. Exactly where to set your stop loss like a winning traders do. Exactly where to set your take profits to finally become profitable. And the trading psychology of winning traders. And the entry models that have made close to $1 million to myself and FTB over $40 million with us. So, make sure you stick to the end, by the way. That's all that this takes. Direction, planning, execution, and reviewing. We simplified this into clear steps that you can repeat daily. You do this for 90 days and you can get funded. If you execute on this exact plan, on the exact entries that I gave you, on the exact model, you will not look back. Forecast every day and plan before every session. So you're basically going to do a market breakdown like I did every day for yourself. And you focused on the direction of the market, because like that, you will no longer be guessing if you should be longing or you should be shorting. I want you to simplify the strategy, increase consistency by having a consistent framework, and journal and review your trades so you can see your weak spots. Is it the reversal model? Is it the continuation model? Is it higher time frame PDRA? What is it that I'm missing? What is my weak spot? If you were to apply everything I taught you today and did it consistently, how would your trading improve? Let me know. If you actually followed these steps for 90 days, how would your trading change? Do you see yourself getting funded? Becoming consistent? Would this have a positive impact in your confidence? I literally did the Telegram to show you this works. I did the exact thing I'm talking about on the Telegram. You can go back to it, to every single market breakdown, and see me doing this exact thing. Here's the higher time frame key level. Here's where I want the market to react from. And if it does, and three trades, 3 wins, 1 loss, is minus 0.5 on the loss. Insane. So if this doesn't improve your trading, I don't see what does. Because this is the exact system that changed everything for people like Jan. Jan got funded 1 day before his birthday, right? And there's already 4 payouts in. And many others. Damien, Bobby, Sander, Miguel, Gabriel, Nabil, GNG, Julian, Octavian, and Marcia. Told you we were going to talk about Marcia. It's today she posted another payout. And it's your turn because you're just as smart of them. You're just as capable and you deserve it. And there's a few concerns that I have. So let's address them in the brief time that we have left. Because it's a massive opportunity and I don't want it to go to waste. Because let's be real, going solo for the next 90 days won't be easy. It's not sexy, it takes reps, time, and effort. The markets change, and without proper guidance, it's difficult to adapt. If you have no accountability, the old habits just end up winning. You're gonna short when the daily bias is bullish. You're gonna long when the daily bias is bearish. Taking this 90 days challenge means taking the time to understand the direction, learning the strategy, 79 forecasts, 79 reviews, and most importantly, staying consistent through it all. And if you're not ready for it, then that's fine. But if you're going to do it, I would advise taking it seriously because trading is not a game. It's a business and you should treat it as such. Now, I'm absolutely confident that if you took everything we covered here today, put it into action for a long enough period, and accepted the feedback the market gives you to make the necessary adaptations, you would achieve results you never thought possible. And if that were your only option, it would already be amazing. However, I know that some of you want more guidance. You'd rather do this with someone who does it every day. You'd feel safer with structure, feedback, and accountability because that increases your odds and shortens your learning period. And if that's you, you need to hear what is coming next. And by the way, this is my first webinar. I'm going to make the most insane guarantee anyone has ever done. So, what if there was another option? An option that allowed us to go at this together. A chance to go deeper than we can in this webinar. What if I played an active role in your results, took responsibility in your success, and had an obligation to your outcome? Keep the obligation part in mind. How would that make things different? Do you think that in that situation where I'm helping you with all resources at my disposal, I would stack the odds in your favor and make success much more likely? If I had shortcuts, support systems, and additional insights that go even deeper into getting you the result you want, desire, and quite frankly, you deserve. If I had such an option for you, would you love to hear more about it and what it could do for you? Yeah, right? So that's with great pleasure that I introduce to you Fund the Trading Blueprint in 90 days to fund it. And again, I'm going to say this again. At the end, you're going to be fucking amazed. Because I was amazed. So, the reason I created this is simple. There are plenty of strategies that maybe work online. But finding the one that fits your life, something that is proven, prove it yourself, backtest, forecast every day alone, is hard. And choosing what concepts of that strategy to make sense and work, still keeping it simple enough for it to be easily executed is an absolute nightmare. And I know, because I did it. And it took me 3 years to become profitable. That's 1,095 days. And you'll get funded in 90. And how much is a 1,000 days speed up worth to you? And how are we going to help you achieve that? We have a full futures course. All the concepts are explained from zero and put together in a way anyone would be able to execute on it. This is the best market to trade because it's very predictable. And that's not all. We have the full Forex course because many strategies only work on a specific market. and not this one. Not everyone wants or can trade the futures market. So Funded Trading Blueprint also has a Forex component. In that way, you'll be able to choose whether you want to execute on the 1 minute or 5 minute on NQ or 1 hour or 4 hour on FX. By the way, you can also execute on 15 minute and 1 hour on NQ/futures. But over the past years, I've seen this happen over and over again. There's always traders telling me, Kimmel, I learned from the videos, but I find it hard to apply. Same thing here. And the thing is, information alone doesn't make you money. Applying that information does. And that's why we give you a full roadmap, which is specifically designed for you to not get lost in the learning process. You also get all of the exercises you need in order to be able to apply these concepts by yourself. Case studies, daily bias, power of three, hindsight testing, back testing. And you'll be able to do them alongside me to never feel lost. And I will make sure that you make the most out of these exercises thanks to the Vault, where you will find all the templates you will ever need in your trading journey. And not only that, you'll find Kimmel AI, the challenge builder, prop firm dashboard, risk navigator, consistency calculator, milestones, everything you need. But now, if you've been trading for some time, you probably know that trading can be lonely and there will be hard periods. But everything becomes easier when you are alongside the right people, like Jeff, who shared his full journey from zero to funded in 23 days. He has now accumulated 3 funded accounts and 7 payouts in under 3 months. Or Jan, who's been mega active in the community ever since he joined and gathers people together to backtest. He just recently had his 2nd profitable quarter and a 4th payout. And I know you might be let down by other mentors. So let me show you this. I wish someone would have showed me this before I entered in anything. In a matter of 1 year, I've sent over 14.8 thousand messages in the Discord. That's over 1,000 messages a month. Talk about being active. And if you have any questions that require a little bit more development, whether you have doubts about a setup you took during the week or about to scale your funding, you can always ask them on the bi-weekly live Q&As that we do. No question is left unanswered. And let me tell you, I did this on purpose. I took this screenshot on purpose because it says 1 hour, 49 minutes, and 30 seconds. These Q&As are supposed to be 1 hour long. But I'm not here like, no guys, no, you have to speed up. If there's questions, they're going to be answered. I don't care. I'm tired of communities that are like, no, my time is... No question is left unanswered. If you have a question, you go to the Q&A, it will be answered. And yes, every session is recorded for you to watch later. And I know what you might be thinking. Even inside of a community, there's more challenges. I've seen it time and time again. People are executing on a strategy they learned, everything is going smoothly, and then everything starts to go downhill. New questions and doubts are going to arise, and you're going to feel lost. Where's the market going today? I don't know what higher time frame PDRA. Did the market cycle change? Why is this not working out anymore? That's why inside of Funded Trading Blueprint, you are never confused. Why? Because we have one market breakdown every single session. You get 2 market breakdowns every single day. One before London for FX and one before New York for futures. So before each session, you already know the bias, the higher time frame level, and have a plan to execute. So literally everything we talked about, it's going to be given to you. In case you go on your own, you'll have to identify the daily bias alone, identify the higher time frame PDRA alone, plan the execution alone, execute alone, and lose or win alone. But once you join Funded Trading Blueprint, you are going to identify the daily bias with guidance, the higher time frame PDRA with guidance, you plan your execution with guidance, you execute with guidance, and you win or you lose with guidance. Because when you lose, you'll see, did Kimmel also lose? But even with a plan, the markets change. What worked yesterday might not work tomorrow. Conditions change. The way you trade a trending market is different from the way you trade a ranging market. And daily guidance helps you adapt to those market conditions. Today I told you I'm not trading. Today I told you, look at the charts, it was range bound. And what else? Besides daily market breakdowns, 2 live trading sessions every week. Like that, not only are you learning, but you're also seeing it being applied right in front of your eyes. And during this session, you'll have more than enough time to ask whatever questions you want. Because every session is recorded for you to watch later if needed. No questions are left unanswered. Because theory is easy, but execution is hard. And most traders know the setups, but can't execute on them. And I know some of you have been part of previous mentorships, and you didn't even know if the mentor traded the strategy themselves. I've been there. In every single community I was in, it was all the same. I never knew. The market is easy to explain in hindsight, but trading it live, that's another story. Which is why all of my trades are called live. Every trade we take is called live in the Discord. Wins, losses, break-evens, everything is shared in real time. Because like that, there's no more doubts on if I'm in a trade with you. And all of this for lifetime. Lifetime. And that's not all. We have, if you purchase Funded Trading Blueprint and for any reason do not want to continue within 7 days, we will refund you everything. No questions asked. A tiny asterisk, because I will ask you why, but just because I want to improve the mentorship for the people that will stay, okay? That's all. This applies to every one-time purchase. So to recap everything, you get the futures course, the Forex course, the roadmap, the Kimmel AI, the vault, the Discord community, the daily market breakdowns, me calling the trades live, the money back guarantee, and a mega guarantee that I'm about to reveal. And all of this, lifetime, for just $29.97 or 4 installments of $7.97. You pay it once and you keep it for lifetime. That is insane. With the money back guarantee, by the way. So, if this is something that interests you, go to joinkimmel.com or scan the QR code. But that's not all. This is my first ever webinar, right? And I told my team that this has to be an absolute no-brainer. And so we added 7 bonuses. Number 1, 12 coaching sessions with myself every single week for the next 3 months. We will gather together to talk about price action for the week so that you're never lost, you learn from your mistakes, you ask whatever questions you want exclusively, and are ready for the upcoming week. You get the blueprint summaries, every video from futures summarized, so you can learn wherever you are and speed up your learning process. You get the FTP indicator. Everything we look at inside of Funded Trading Blueprint automatically applied in your charts. Sessions, power of 3, daily and weekly opens, your own bias. It's everything we use to trade built into one indicator. You get Trade Blocker lifetime. You cut your trading when it counts. Trade Blocker is the software that allows you to do this. It blocks all of your trading apps, trading websites, everything you need to either block your trading when it matters most or to block your distractions when you're trading. This is the ultimate tool if you want to stop overtrading. We want to stop your overtrading now. So you'll get lifetime subscription to Trade Blocker. You get the winner's playbook. You're going to learn to win from the last 30 winning trades that I've taken live. The best way to learn is to learn from the winner's playbook, from the winners. Everything broken down so you can learn from the trades that matter most. You get a $50,000 prop firm challenge with funding ticks. We want you to get funded until the end of the year. And to speed that process up, we're buying you the challenge. That's how confident we are. We're buying you the challenge. And last, when you get funded, within the first 90 days, you will receive a one-on-one call with me. This is not available for purchase anywhere. With the sole goal of getting you to that payout that you desire. So let's recap everything. And I still have the mega guarantee. I don't know if you guys are ready for the mega guarantee. Oh my God. That's not all. Remember when I said we have the most insane guarantee this industry has ever seen? So here it is. What's the name of this challenge? It's funded in 90 days. So if you don't get funded in 90 days, once you join Funded Trading Blueprint, I will refund you every single challenge fee you took during those 90 days. Every single challenge fee will be refunded to you if you don't get funded. That's how much I trust myself. So if by the end of the year you haven't gotten funded, we will refund every prop firm challenge you bought. Every single one of them. That's how much I trust our edge, my team, and myself. No one has ever done this because they can't. They know it's not going to work. I know it's going to work. So that's my insane guarantee. I call it the holy shit guarantee. If you don't get funded, we'll refund you every single challenge fee. Every single one of them. Terms and conditions apply. Obviously, don't. You're not going to run up a 10K tab, but I call this the holy shit guarantee. So you get everything. Futures course, Forex course, roadmap, Kimmel AI, the vault, private Discord community, daily market breakdowns, 12 coaching sessions with myself, blueprint summary, FTP indicator, trade blocker lifetime, winner's playbook, a $50,000 challenge, a one-on-one coaching call with myself. And if you don't get funded until the end of the year, we refund you all of your challenge fees. And this is all lifetime. It's not those, oh no, it has to be yearly because we want to make more money out of these people. No. Once, lifetime, that's it.